Good morning and welcome to the Shenkman Wealth Management Accountant Attorney Fall Webinar Series. This program is entitled, Your Client Received a Foreign Gift but Filed Form 3520 Late. How to Respond to the 25% Penalty. For those who don't know me, my name is Jonathan Shenkman, and I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my program is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, U.S. News and World Report, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. One more quick note before I introduce our esteemed speakers, and that is that the handout to this program was sent out within the reminder email this morning. It will also be sent out again in the follow-up email tomorrow morning as well. Today, we're privileged to hear from Stanley Ruchelman and Neha Rastogi, both of the New York-based law firm Ruchelman, PLLC. Stanley is chairman of the firm where he has decades of experience in sophisticated corporate restructuring, individual tax, and multinational compliance matters. His clients include non-U.S. individuals and foreign corporations operating or investing in the U.S., foreign financial institutions doing business in the U.S. through branches, and U.S. individuals, corporations, and financial institutions operating or investing abroad. The core of his practice includes tax advice under the international provisions of the Internal Revenue Code, analysis and advice on U.S. inbound and outbound commercial and financial transactions, and advice on transfer pricing matters and representation before the IRS. Neha regularly advises domestic and foreign clients in a broad area of tax-efficient structuring. She has authored numerous articles for Insights, the international tax journal published by Ruchelman. Recent assignments include advising a European corporation in the financial services space on required due diligence and U.S. tax compliance incident to the sale of a portfolio of domestic and foreign investment funds. Today, Stanley and Neha will be speaking on Your Client Received a Foreign Gift but Filed Form 3520 Late. How to respond to the 25% penalty. With that introduction, I'll now turn the program over to Stanley and Neha.
Thank you. Neha, next slide. Good morning, and thank you for attending. We're going to start with just a brief explanation of the purpose of the 3520 form. I suspect that anybody who's interested in this program knows what it is. It's the reporting form that reports trust distributions received by U.S. people. It reports ownership of foreign trusts by U.S. people, and it applies to receipts of certain large gifts or bequests from certain foreign persons. Today's presentation will focus on the last item. Your client has received a gift and has failed to report. Now, it's not a tax obligation in the sense of paying tax. It's simply, please go back one slide, to filling out line 54 of the form 3520, which asks for very little information. It's amazing how something that is that tiny can produce so much agita in the U.S. Today. Next slide, please. So what gifts must be reported? The whole purpose of this, in a sense, is an anti-money laundering purpose. It's not designed to raise revenue, but it's designed to keep track of people who may surreptitiously have hid money, still hiding money, and need access to it, and receive funds through an ersatz gift that may not be a gift, but may be inappropriately owned outside the U.S. The triggering point is $100,000. It does not increase by inflation. It's $100,000 that's received from one person or in the aggregate a group of related persons. You see the example on the screen where husbands and wives are viewed to be related. If there is a distribution from a revocable trust, the distribution for technical tax purposes is a gift, meaning it's not subject to tax in general, and but it must be reported on the 3520 on the part of the form that deals with trust distributions. Next slide, Neha, just show where the slide is. Part 3, distributions, and essentially you need to answer these questions and give some thought as to whether proper answers are yes, no, and possibly not applicable. Next slide. So the penalty regime is very simple. If the form is not filed on time, the penalty is 5% per month of the amount that should be reported. The penalty is capped at 25%. And you can see the address to which the form is sent. The form is due to be filed not later than the due date and filing the due date of the income tax return, but it's not filed with the tax return. It's filed separately with the Ogden Service Center. Next slide, please. If the form is filed late and the IRS discovers it, and it may discover it because you filed a late form, the penalty is not a tax deficiency. The IRS treats the penalty as due when asserted unless appealed. The appeal is an administrative appeal to the IRS Independent Office of Appeals, and it's based on having reasonable cause for failure to timely file. Please note that the appeal does not stop the running of collection notices. If the IRS sends a notice to levy on bank accounts and other property under standard collection procedures, a due process appeal may apply either administratively or to the U.S. tax court. If you fail to file and your client says, well, why should I file because of the penalty? There's an unlimited statute of limitations until the form is filed. So that 3520 exposure lasts until discovered. Someone may ask, what are the odds of it's being discovered? I'm not a bookie, I can't tell you. The problem is it's a big problem if the IRS discovers it one way or another and the taxpayer fails to discover it. The IRS has in place what it calls a delinquent international information return submission procedure. It's a program to invite people to come in, file forms, hold your hand, saying kumbaya. But it's really a Judas Goat. Judas Goats lead sheep to slaughter, and the IRS has an automatic assertion of penalty program. It reportedly does not read any reasonable cost statements. It's just designed to trigger the process and kick the problem upstairs. Neha?
Right. Thank you, Stan. So now we're going to move and talk about the IRS appeals procedure that needs to be followed after you file a reasonable cost statement under the delinquent procedures. The very first correspondence or communication that you're going to receive from the IRS after you file a reasonable cost statement is a letter CP 854C. Now, what it does is it kind of informs the taxpayer of the fact that the IRS has either partially or fully denied the penalty request. And this is something to be expected from the IRS because as the delinquent submission procedures, the page on the IRS website basically suggests that it would typically not consider the reasonable cost statement that goes along with the late Form 3520. And you would probably have to file or resubmit the reasonable cost statement once you receive this notice. So this is something that should be expected. It should not come as a surprise. And if you don't receive a CP 54C. That should be a surprise for you. Anyway, so basically the letter itself tells you what exactly needs to be done. You would typically get a 60-day period from the date of the letter to respond to this notice. The response is called a protest letter or an appeal, which is filed with the Independent Office of Appeals. And it basically tells you what needs to be incorporated in the protest letter. The first thing, of course, is the name of the taxpayer, the address, and the tax identification number of the taxpayer. You would also include a statement that would state that you are appealing the findings of the letter CP 854C. And then comes the most important piece of information, which is the statement of facts and statement of law. Stan is going to go into details of what is included in the statement of facts, but I just want to briefly jot down the points. Of course, you're going to include the facts as they occurred in a chronological order. But at the same time, in our experience, what we have seen is that the appeals officer is typically looking at four factors. The first one is that whether the taxpayer was reasonable in engaging the professional on whom he relied for preparing the tax return for the year for which the 3520 was not filed. So you got to explain in detail the professional experience and the qualification of the tax professional. It's a good idea to also incorporate the website of the tax professional that you relied on. And also maybe discuss similar cases where the tax professional had experience working on a similar matter where a 3520 filing requirement was existed. The second factor that the IRS, the appeals officer is looking is to see whether the taxpayer provided a complete list of information that was necessary for the professional to determine whether a 3520 filing requirement was needed or not. And then the third one is whether the taxpayer actually relied in good faith on the judgment and the advice of the tax professional. And that is typically gathered by the fact, like the length of professional relationship between the taxpayer and the professional. Longer the relationship, higher is the possibility of the agent determining that the client actually relied on the advice of the professional. If there had never been any hiccups in the past with respect to the advice that the professional provided, then again the reasonableness standard is expected to be met. Now we've also seen that where there is a client who lives abroad and he does not have a US address in the IRS database. In such cases, typically what happens, the CP 854C is received by the client way after the due date for filing a response has passed. Now, what do you do in this case? Now, what we have seen is, and what we have done in a couple of our couple of our clients, is that we not only respond to the letter, assuming that we are filing the submission within time, but at the same time we also attach to the submission what we like to call as a due process statement. And the point to be noted here is it is not the same as collection due process, but it's a due process statement where we are alleging that if the taxpayer is not provided an extension to respond to CP 854C, then his right to due process is being violated. And the right to due process is nothing but a fundamental right of an individual to be given a reasonable opportunity of being heard before any property is seized. And there is a stream of case law which are indicated here on the slide, which basically provide for the same. They talk about due process and how a property cannot be seized without giving an individual a reasonable opportunity of being heard. So that's what we've done in a couple of cases, and we have been successful to get a conference call scheduled with the appeals officer. Now, the next question is, once you file the protest letter or the appeal, the wait game starts, and you would expect a response from the appeal. Now, typically you would receive a letter numbered 5157, which would schedule a conference call with the taxpayer It would have the date and the time and the phone number for the conference. And of course, the appeals officer are typically very flexible in terms of the date. So if the taxpayer or the representative rather is not available, you can give them a call and reschedule the conference call. And typically, again, the officer would give you enough time to prepare for the call, and it's a two-way street. The officer might request you to provide further information which he thinks is important to make a determination, and at the same time, you can also provide information which you think would be supportive and would result in a positive determination. Okay. And then, of course, this is a great helpline number. What you can do is, see, you filed a response to CP 854C. Now you're waiting for the appeals officer to respond. It's been months, it's been years. You've not heard back from them. Now, if more than 90 to 120 days have passed, what you can do is you can give a call on this number. It's a recorded line. You would leave a message. You would identify yourself as the representative of the taxpayer. Give them a little bit of background about the taxpayer and the reason why you're calling. And then the IRS would, and if the IRS has received the submission and has updated the system with the submission, then you would actually get a call within 48 hours from an IRS agent who would give you the identity, the name, and the contact number of the appeals officer who's been assigned to your matter. And I think it's a great feature which can be of real help. We recently did the same thing for another client. We called this number early this month, and we just concluded the conference call, and the client is very happy with that. So I think this is a very useful number to keep handy. Now, sometimes what happens, IRS is full of surprises. So sometimes what happens is, instead of receiving a CP 854C, you would receive a notice called CP 15. Now, there's nothing to be worried about, but the only difference between a CP 15 and a CP 854C is that CP 15 response goes to the collections department, not the Office of Appeals. So it kind of just increases the processing time for the settlement, because once you respond to CP 15 in the same way as you would for CP 854C, you would receive a letter from the collections department saying that they're not equipped to handle this matter, and then they are forwarding the matter to the Office of Appeals. So that's the wait time. It kind of increases the processing time for settlement. And again, another thing is, notice CP 15 does not identify the reason as to why the tax or the penalty is being imposed. So you have to, if you're aware of an ongoing matter for the client, and you recently submitted a reasonable cost statement and the amount due is roughly about 25% of the value of the gift, then it's a good guess that this pertains to the late filing of 3520. Another point, like Stan mentioned, is that the appeals process does not stop the collections process. So while the appeal is pending with the Office of Appeals, you would continue to receive collection notices, and typically you will receive collection notices in this following order. There are four letters that you would typically receive, which is CP 501. It's a slight reminder. CP 503 becomes a little more urgent in terms of wording, and CP 504, where the IRS is indicating an intent to impose a levy or a lien on the property, and then CP 90, LT 11, LT 1058, and letter 3172. These are the four letters that actually inform the IRS that a lien or a levy has been imposed. So in cases of Form 3520 late filing, we have seen that typically a letter 3172 is received, and along with the fact that informing the taxpayer that a lien has been imposed, the IRS also advises the State Department of the fact that there is an outstanding there's an outstanding amount of tax due from this particular taxpayer. And if the amount of tax due is in excess of $55,000, then there are also instructions from the IRS to the State Department to refuse to renew or issue a new passport to this taxpayer. So this is pretty serious. So now the question is, you received a 3172. What do you do? How do you respond to a letter 3172? The answer is provided in the letter itself. So what you do, letter 3172 would give you the right to apply for what is known as a collection due process hearing. And this is done by filing a form 12153. What needs to be remembered is the fact that there is only 30-day period within which you can, from the date of the letter, within which you can request a CDP hearing. If you do it timely, then you can challenge the appeals decision in US tax court. However, if the 30-day period has passed, then you can still request a hearing, and that's called an equivalent hearing. But the only difference is that, and it's a major difference, is that you will not be able to challenge the outcome of the appeal in US tax court. Again, what is a CDP hearing? The most important thing to remember in case of a CDP hearing is the fact that you can only challenge the means of collection or the amount of due. The underlying liability cannot be challenged. The underlying liability that has resulted in this collection process cannot be challenged. There are a few exceptions though, but we will just go over the main issues that can be addressed in CDP, and then we'll talk about the cases where we can challenge the underlying liability. So I'm going to quickly go over this. So you can challenge the amount or the means of collection on the grounds that you already paid all the taxes, or the fact that the taxpayer cannot pay the taxes because he doesn't have sufficient funds, or he is suffering from a terminal illness. The only source of income is Social Security, welfare, or unemployment benefits, or that he's claiming for innocent spouse relief, where he's saying that it's my spouse who was responsible for filing the tax returns, and it's his or her fault, not mine. And another issue that can be raised is the fact that the taxpayer thinks that statute of limitation has passed. And then there are several other issues that can be raised in a CDP hearing. For example, the taxpayer probably wants a different way to pay taxes. Maybe he wants to come into arrange an installment plan or offer in compromise with the IRS and not a lien on the property. Now, I said that there are only few cases where the underlying liability can be challenged, and the very few instances where we have seen, where we have challenged the underlying tax liability is one where you did not receive the first three collection notices from the IRS, and the very first notice that you received from the IRS is this Form 3172. So you can actually argue the fact that there was no opportunity of being heard that was given to the taxpayer, and that's why the CDP and that's why this collection process is completely violative of the fundamental right of this individual. And then quickly, we're going to go through the consequences of a CDP hearing. Two things happen when you file a CDP hearing. The first is that all the levy or the lien gets suspended, and it also suspends the statutory 10-year period to collect the taxes. And what happens is, after the determination is made by the appeals officer, the amount of time that it took for the appeals officer to make a determination is added to the balance of the remaining time in the 10-year period. And of course, you can challenge the determination in US tax code if the request for a CDP hearing was made timely.
Neha, can we move on to the strategy and things to remember?
Yes. Yes, I was just getting there. Stan, why don't you? Yeah, go ahead.
Okay, so too many times when we see first drafts of appeals submissions, and we come in as second chair, what we see is something that's very bland. It's a few facts. It's a recitation of the cases. The examiners have all seen these cases. They've seen hundreds of protests. They're really bored. And if you have something that looks like it's canned, you'll get a canned response, and the canned response is really not good. So the first thing that we recommend is to emphasize the professional credentials of the advisor or the tax return preparer. This is immensely important for two reasons. One, you have to show that you did a good job in finding the person and he was capable. But ultimately, you're going to have to say he committed an error. So if you don't build him up or her up when filing the appeal, all the agent is going to see is someone with a tax return preparer and made a mistake. Well, that's not good enough to win the case. It's not good enough to move the needle. So as Neha had said, you have to show why it was reasonable to choose this advisor, how much information was given to the advisor, and did the taxpayer actually rely on good faith? I like to tell people that more detail is better than less detail. It typically, in our firm, when we write, we believe that less is more, but this is not that case. The guy has to, or the woman has to walk on water. He has to be real good. She has to be excellent, top of the class. And anybody who took his obligations seriously would go to that person. And even that person couldn't ensure that everything took place correctly. Examples where we see problems on the next slide is a gift made at the end of the year, when a gift to a trust made at the end of the year when no tax return is due because the U.S. trust has no income. And it's not atypical for the client to believe if there's no trust, there's no Form 3520, because they're both IRS forms. We have issues with that. We have issues of gifts of intangible property that have value but don't produce cash. They produce a potentially accrued income, but there's nothing in a bank account that triggers someone's concern. And there are other issues that the tax return preparer has been rushed and looked at a prior year's return, which didn't include this particular issue. Now, if we go to the next slide, this is a real interesting case because for one reason, there are reports that appeals officers are demanding a payment, partial payment of the penalty in order to eliminate the problem. It's, it's hazards of litigation. They're doing us a favor. You got to pay for that. There's a toll charge to get absolution. And that really is opposed to IRS policy, where the IRS is instructed to come to the right answer and not to raise hokey arguments. They don't use the term hokey, but that's what it is. To demand something to give absolution. In this case, I think it's Wierzynski v. U.S. It's in the Eastern District of Pennsylvania. It started in September or October, and it involves a quintessential issue of a taxpayer who on the surface did nothing wrong, went to an advisor, in this case an enrolled agent, was given bad advice. The IRS, when the fellow went back to make a gift to someone overseas and did a Google search of his reporting obligations, he realized that he was given bad advice. Saw a lawyer and entered the program, the delinquent international information reporting procedures, and thought he had a good case. The IRS said, yeah, you do have a good case, but we want 20% as a penalty. He made the payment, then filed a claim for refund. When that was denied or nothing happened, he brought an action in Eastern District. And I think this case, if it goes to trial, is the type of case that will bring clarity as to the exact scope of the rights of taxpayers. I think we're about to run out of time. And what I want to say is that if you have questions, Neha and I are available for a phone call. Talk is cheap, and we'd be more than happy to listen and speak and give impressions on any issues that you may have. Our office phone number is 212-755-3333. Neha, what is your email address?
It's Rastogi at ruchlaw.com. It's RASTOGI at RUCHELAW.com. You can find me and Stan on Ruchelman's website as well. It's ruchlaw.com. That's the website.
Great. Jonathan, thank you for inviting us.
Great. Thank you so much, Stanley and Neha. If anyone has any specific questions, new business opportunities, any of the issues they'd like to discuss, you can feel free to reach out. Stanley, Neha, or myself where appropriate. Now, be sure to include their contact information again in the follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, this is my last fall webinar. However, my winter webinar series starts December 15th. I'll be on the topic of 10 practical but overlooked pointers when doing estate planning, featuring Avi Kestenbaum, partner and co-chair of the Trust and Estates Practice Group at Meltzer Lippy, based in Long Island, New York. I'll send out an invitation to this and all of my upcoming webinars after the program. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. And I thank you in advance for that. Finally, if you or a colleague would like to be kept abreast of my latest articles, webinars, or all the other work I put out, you can sign up for my free monthly newsletter. Simply email me with the word newsletter in the subject line. You can also follow me on Twitter, YouTube, and Instagram. My handle is @ShenkmanOnMoney. And with that, this concludes today's session. Please stay safe, healthy, and have a wonderful day, everybody.